Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios here today as we just got off a Fed meeting yesterday, some big tech earnings last night, got some more on tap here after the market closes at 4. A ton of information to get through here for all of the viewers. Thank you for watching the Shepherd Wealth Management podcast. You might be listening to us on Spotify as well. Thank you for your viewership. Please remember to like, share, and subscribe to the Shepherd Wealth Management podcast with friends, family members, and coworkers, especially as we are gathering together around the holiday season. Halloween is tomorrow. Very excited about that with a 7-year-old daughter. She's super excited. And the 1-year-old or soon to be 1-year-old that we have going to be her first uh, trick or treating experience. We'll see how the weather is for her. I know my 17-year-old daughter will be passing out candy and having a good time too. And of course, we got World Series wrapping up here. Looks like the Blue Jays got one more to go. Um, and of course, football season still upon us. So this is a great time of year. I mean, I don't know what other time of the year would be more fun than this time of year. But we got a lot to get to here today, Ed. So I'm probably pretty excited about this Halloween. I'll say that. It looks like the weather's going to be okay. So we can see how that goes, I guess, for all the other little trick or treaters out there. But it's generally a pretty good time for the adults, at least in our neighborhood, because there's so many little kids running around everywhere. Everybody's kind of policing each other as we're walking down the street, maybe enjoying a adult beverage for the time that we're spending outside walking around. I know a lot of the people in our neighborhood, these adults are handing out some of that, so like encouraging, having some fun. But anything you're looking forward to this Halloween as before we actually get to the what my wife would call the real holidays, Thanksgiving and Christmas. This is very much a roadblock that she's looking forward to getting behind. Not that she doesn't celebrate, Halloween and doing all that, but she'll probably have the Christmas tree up right after this is over, folks. It's just how we roll in this house. So I don't know if you got a favorite movie or a favorite tradition as for Halloween. We just kind of do the normal thing. Nobody likes scary movies in my house except for me. So unless I want to watch it by myself, it's just not going to happen.
Yeah, same. I love watching scary movies and handing out candy. This is going to be the first year in probably 6 or 7 years where I'm actually in a neighborhood where there's going to be trick or treaters. So I'm really excited just to kind of stay home, throw on scary movies, and just see all the fun costumes and see all the kids running around. I got a tradition where every year I get a bunch of glue sticks and save all the cardboard boxes I come across for about 4 weeks. I just make a really fun mask and paint it up all fun. Then, when it's finished, I throw it in the recycling because it's just cardboard. So I'm
Yeah.
gonna be doing that during the day, Friday, just kind of getting ready. Yeah, like you said, hopefully, I mean, just get World Series real quick. Dodgers fan when they're not playing the Reds, but I wouldn't hate it if the Blue Jays won, just to have a different champion this year. So I'm looking forward to. Hopefully, we get 7 games because I don't want the season to end. But
For
either way,
sure.
I don't really have a skin in the game. So looking forward for a good wrap up to it.
Yeah, yeah, me too, man. A lot of other sports things love to talk about, but this isn't a sports show. This is all about the financial markets. And if this is your first time checking us out, welcome. You're in the right place here today. What we try to accomplish here with this podcast that we've been doing for 4.5 years now, I believe, as
Yeah,
something right around there. I don't know how many videos that is, but
we're coming up
about
on our
every
100th episode.
we
By
might
the
have
end
to
of
get
this
some
year, we'll hit it
champagne.
in December.
Uh-oh, champagne time almost. That might be a good one. Remind me about that later. But the whole point of this show, the reason why we keep doing this every 2 weeks or just about every 2 weeks, is not just to give me something to do, although I really do enjoy this time. The primary reason why we do this is because I understand that a lot of people, a lot of investors, humans are very busy with their life, like me. They might have children and animals they got to take care of, work to do, maybe a spouse, loved one that is also at work, and those types of things. But we also have to prepare for the future. And we all have these things called a smartphone, and we get all these headline news blips throughout the day. And usually, just because the news is a for profit business, are generally a little bit more fearful in nature. And the reason why the news will do that, by the way, is because they understand behavioral finance maybe better than any other for profit business out there. They understand that humans are risk averse by nature. In other words, we feel losses twice as much as we feel good about making a gain. And if the news understands that you're twice as engaged when you're a little bit more afraid than you are happy or excited, Well, there's your news headline in general. To keep you twice as engaged, they can sell more ads at a higher price, making them more profitable. Um, our job here is to say, yeah, you're going to continue to receive those little messages on your smartphone saying, hey, this is the news headline from the Fed meeting yesterday, which we're going to talk about, or all these earnings announcements from all these big tech companies, which we're going to talk about here again today. We will cover that because the news is bringing something to your attention, but there's also this thing called history. And there's also this thing called a market, and the market is made up of other human beings. So the good news is the news can bring things to your attention. Understand most of the time it's going to be fearful because they're trying to make a profit and grab your attention. But there's also this historical precedent of other human beings that had to make decisions with their investments right now. And we're going to look at what history has to say here yet again today to help us understand how we might want to think about the rest of this year positioning wise. And it ties perfectly into everything that happened yesterday, which we're going to start talking about right now. So, Fed Chair Powell made an announcement yesterday after a 2-day Federal Reserve meeting. They decided to cut interest rates, Fed funds rate by a quarter of a point or 25 basis points, bringing the Fed funds rate down to 4 to 3.75. And there will be some balance sheet runoff beginning December 1st, meaning that they're just not going to replace those mortgages that are rolling off their balance sheet. They'll take that capital and they're going to buy short term treasuries, increasing the money supply by doing that, which is certainly a liquidity event for markets and definitely a good tailwind for stocks as you're starting to think about 2026, which will have a lot to say about 2026 expectations and history and all that sort of stuff as we get a little closer to the end of this earnings season. So stay tuned. Early December, very likely to be pretty much wrapped up with all the major earnings announcements. And we can start to look forward to 2026. And we'll have you covered here at the Shepherd Wealth Management Podcast. Now, getting back to yesterday's major market news regarding this Federal Open Market Committee announcement. Um, Here's what happened, or here's what Powell said that really stirred the market. So, Powell now, and this is coming from Barron's, by the way. The title of this article is Powell signals Fed may not cut again this year. Here's why. This is written by Nicole Goodkind, and this was written today, or I'm sorry, late last night, after the market had already closed. So, Barron's article here. Fed Chair Powell acknowledged, quote, strongly different views within the Federal Open Market Committee during October's policy decision. Governor Stephen Myron dissented in favor of a larger 50 basis point cut, and Kansas City Fed President Jeffrey Schmid voted for no change. So he also dissented. Still, Powell said the disagreement was, quote, really about the future. Now, Powell's warning about December was the most important line from his press conference, wrote Dario Perkins. He's the managing director at TS Lombard. The far from it part was kind of unnecessary, he said, and heavily loaded. He intended to send a signal, and the Fed clearly wants to go into its meeting in 6 weeks' time. That's the December meeting with its options open, Perkins noted. Powell has long been viewed as a consensus builder, steering a committee that prizes uh, clear communication and consensus. The skill is now being tested. Quote, uh, there seems to be a lot of different views on the committee, more than I can ever remember, with dissents in each direction, said Brian Reeling, head of global fixed income strategy at Wells Fargo. Differing views become more so when Powell's term gets closer to ending. There's a lack of data and visibility, and there's a lot of uncertainty. That's what today's press conference was about. Powell goes on to say downside risks to the unemployment have increased in recent months, but he added, you don't see anything that says the job market or really any part of the economy is making significant deterioration. Inflation, meanwhile, is still running above target. Powell estimated prices have risen 2.8% over the past year, with goods inflation picking up because of some tariffs, even as housing and service inflation continues to cool. Inflation, according to Powell, is away from inflation away from tariffs. In other words, if you remove the tariffs, inflation is certainly closer to its 2% goal. But caution the impact of tariffs, quote, could be more persistent, and that is a risk to be assessed and managed. The economy, however, has also surprised to the upside, regardless of Fetcher Powell's view on tariffs. Getting back to the article here, The Atlanta Fed's closely watched GDP model shows the US economy is surging ahead at 3.9% annualized growth rate for the third quarter of the year, and growth from the second quarter has been revised upwards. Powell said growth, quote, may be on a somewhat firmer trajectory than expected. I'll have to come back to that. Driven by resilient consumer spending, the strength combined with persistent price pressures has some officials questioning whether policy is already close to neutral. There's a growing chorus now of feeling like maybe this is where we should be um, at least wait a cycle, Powell said. Robert Tipp, chief investment strategist at PGIM Fixed Income, said in a note that the challenge now is Powell's ability to keep the committee aligned. Um, and lastly, this shock was stark to markets on Tuesday. Investors were pricing in a 92% chance of a December cut, according to Bloomberg data. Today, that is down to 67%. So it nearly got whacked by a third. Still above 50% chance of a rate cut in December is worth noting, though. Powell is still trying to steer a consensus around increasing uncertain economy, one where growth and inflation remain stronger and expected, even as job creation slows. Whether the next move comes in December or later, the balance of risk that once pointed toward easing no longer looks so one sided. This is unbelievable. Commentary from the Federal Reserve chairman. Yes, he did the expected thing, the 25 basis point cut, but you have a lot of professionals from all kinds of different organizations here, some on the equity side, some on the fixed income side. And basically, what they're saying is this: those comments about the future path of the Fed's next meeting were completely unnecessary. He was trying to make a point of throwing cold water on this economy that there's absolutely no reason for it. You should be a cheerleader for America's growth. There's clearly a ton of growth that's happening right now. And by the way, you were wrong about that. You and the government surveys were calling for 1.8% GDP this year or worse. And most of that was less than 1.8 by a lot of people, including the Fed, chairman himself, because they believed that inflation was going to be persistently driving higher due to tariffs and the tariff policies. Now, not only have we already had a historical precedent of this during Trump's first administration in office, that they were also very wrong about at that time, they continue to ignore history, ignore the actual results that have happened over the course of the first 10 months of this calendar year, and continue to stick with old, antiquated talking points based on their own personal feelings and preferences, right? He basically said, had there not been any tariffs at all, we probably would continue to cut rates. We'd be at 2% inflation, is pretty much what he's implying. And he might be right. He can't prove that, unfortunately, for him. Um, but that's kind of counterintuitive to what he was saying anyway. That inflation is, in fact, a one time price spike. And after the inflation is done, in other words, after the last tariff has been placed on a good, there isn't any more tariffs coming, right? So therefore, there's no persistent inflation. That's been the argument of many, not very many, at the Fed, but that is a growing consensus. That's why you're seeing some serious division there, for certain. But they've certainly been wrong. At least Fed Chair Powell and the other half of the committee have been wrong about GDP growth this year and about what tariffs would do to inflation. They've been wrong about both things all year long. And data staring them right in the face, even with the government shutdown, they can still get private employment data. That's not going so well, at least not as well as what they would like it to be, which is part of their mandate. That's half of it. Full employment and price stability. That is inflation. Well, inflation came down. The most recent reading that we got, CPI, definitely came down. We did not get the PPI, the wholesale reading again, because the government shut down. Therefore, we don't have the Fed's favorite measure of inflation, which is PCE. So certainly rooting for the government to get open sooner than later, not just for the data, but also for those that have been affected by that. But the point I'm coming back to here is, why would you make that statement that we are far from a lock of a 25 basis point cut? You could have said the same thing 100 different ways. Here's the way that I probably would have tackled it as the Fed chairman. Hey, that's a great question. history would support the fact that once we've started cutting interest rates, yeah, I can understand why the market might price in a high probability of a rate cut at our next meeting. And if the data continues to come in as it has, with inflation slowly but still trending towards our 2% target, along with the unemployment rate not getting so tight, which is clearly not right now, yeah, there's a realistic expectation that we could, if that worked out the way that we're describing it between now and our December meeting, yeah, I can understand why the stock market would price that in. And by the way, the market is the market. It's going to make its own decisions about what things should be priced at, whether it's bonds, the interest rates on those bonds, securities, real estate, the whole thing. The Fed can do absolutely nothing with the tools that they have, which is really interest rate policy. They can do absolutely nothing about any of those things. Their job is not to tell you whether or not something is overpriced or underpriced. They're there to do two things. This is what Congress created the Fed to do: maximum employment and price stability. And we're going to give you the opportunity to affect those things by controlling the short end of the interest rate curve, specifically the 2 year Treasury note. And that is almost always a leading indicator of where interest rates are headed. And where is the 2 year right now? It's much lower than where the Fed funds rate is at 4 3/4. The 2 year is sitting right about 3.5, a little less than that, depending on the time period that you're looking at here. What that tells you is there's more interest rates to come, more interest rate cuts to come. That's at least what the bond market is telling you. There's absolutely no reason to say what he said. Matter of fact, the very first question that was asked by Nick Timmeros of the Wall Street Journal, who I have come to have a lot of respect for as a journalist, um, because he does, call it like it is. He calls the balls and strikes. I really appreciate that about him. He looks at history, and that helps him come up with some of the questions that he will ask the Fed chairman. And the question was very blunt and straightforward. And the question that he asked was, Mr. Powell, thanks for taking our questions today. Are you mad that Wall Street, the market, is pricing in a 25 basis point cut ahead of your December meeting? And that's where this comment comes into play, right? I don't understand why he had to take a stand there. You're supposed to. You're supposed to, in every meeting that he's ever had, as I know that you know this is true because we've been covering this every time the man talks for 4.5 years. Every single time he's asked a question about, hey, how's the committee thinking about the next meeting? And what's the outcome that you would expect to have happen? He always gives optionality going into the next meeting, saying, "Hey, our job is price stability and maximum employment. We'll take in all the data, we'll assess the balance of risk, and we'll make a decision." I mean, I could rattle it off because I've been watching the guy every single meeting 6 times a year for 4.5 years. I don't have any notes, but that's exactly what the man said pretty much every time he's asked that question. But this time it had to be different. Why? GDP is running at 3.9. Why can't you say something positive in one of these meetings? Saying, you know what, this market's growing a lot faster than we thought. Gross domestic production here in this country is way higher than we thought. We thought tariffs were going to have a much bigger impact on all this stuff. We've gotten a lot of that stuff, not so accurate. Therefore, we need to be open minded to damn near everything. Anything is possible going into our next meeting because we've certainly forecast a lot of this stuff incorrectly. Therefore, you can actually, if you're being honest with yourself, you can make some true assessments here. Maybe this is true. This was talked about early in the year. It's going to be a talking point for sure in 2026 as a new Fed chairperson will be named. Maybe it's really a healthy thing to consider how we go about doing our business at the Fed and making these decisions. Might be something worth noting there. I'm sure artificial intelligence can certainly help him out with that. But nonetheless, we got our 25 basis point cut, which was expected. Unfortunately, even though the markets were very excited going into that announcement yesterday, all of the major averages were positive. As soon as those words came out of his mouth, which is right at the beginning of the press conference, essentially, markets turned over. Now, finished flat for the day for the most part. Nasdaq was in the green, but today we're still seeing repercussions of those comments. You're seeing a mixed bag. You see small caps up a little bit, Nasdaq's down about 1%, Dow Jones is positive, and the S&P is slightly down. So the market will likely be buying this dip. A lot of it has to do with some of the earnings announcements that I'm about to get to. But I want to give everybody our take regarding the comments that Fed Chair Powell made yesterday. Um, so here we go. Our take of the press conference that Powell had are as follows. The Fed now is viewing tariff related price increases as one time and not inflationary. That's a good thing. So this is a change in tone from their prior meeting. Okay. There's one positive that you can take away there. Second, therefore, the PCE, the Fed's favorite measure of inflation, could be implied, if Powell's accurate of his assessment of, headline inflation. PCE inflation could be implied as about 2.3 to 2.4, which is not that far off from the Fed's target of 2%. Again, Powell said had it not been for tariffs, then we probably already be or real close to our 2% target. So that's kind of where that is coming from. Third, the Fed will not have PCE information due to the government shutdown. And if you don't have information, you probably should lean on the conservative side of things and consider cutting interest rates, in our view. That will be supportive of demand for hiring. That's exactly what Fed Chair Powell said yesterday. One of the good things that he said. Fourth, labor markets are showing slowing job gains, which he views as due to supply. In other words, the immigration policy having fewer people for a job is where you're reducing the supply of workers. Less workers um, could affect the unemployment rate. Maybe, maybe not. Hasn't really affected it so far yet, but that is something that, in our view, can be viewed as a potential dovish signal from the Fed that, hey, we don't have enough people here. We are starting to see some layoffs, but not a ton. Therefore, unemployment rate could change a little bit here, and we probably should keep our eye on that more so than inflation, given how wrong they were on the expectations of inflation coming into this year. And lastly, um, job growth certainly has been close to zero, according to Powell, which is again more likely for a cut. But current rates are looser. But according to Powell, I wouldn't say that they are accommodative now. In other words, they did reduce their interest rates by 25 basis points yesterday. But even in Powell's own words, he wouldn't say that they are accommodative rates. They're not too loose, in other words, which means that there's more room for interest rate cuts. Now, we really had to dissect those comments that he made to come up with this. Okay. So hopefully we can get the government back open and get some of this BLS data. Because in Powell's own mind, and this is what he said yesterday, if you're driving or navigating through the fog, in his words, you want to slow down. And that would imply a potential no change in their interest rate policy in December. And that's what, changed the probability of the December rate cut from over 90% down to 67%. However, we still believe here at Shepherd Wealth Management that he will, in fact, follow through with another 25 basis point cut, even though as of yesterday and probably even still today, would not like to do so for whatever the reason is. And you really can't point to any actual data as a reason why you don't want to cut interest rates from where they are here today. Now, I know that we don't have current, data as of last month on the PPI and the Fed's favorite measure, core PCE and headline PCE numbers, but we have had quite a bit of data already this year, and it's certainly come in much, much better than the Fed had expected. Um, but part of the reason for the soft jobs numbers has certainly been a benefit for artificial intelligence. Corporate profits for these companies are leveraged to AI, and the benefit from this shift, meaning equities could rise and job market weakness could happen. But this would actually lead to a dovish Fed, meaning more interest rate cuts because of the impact on jobs that AI may be taking. So that is our take that we do expect another 25 basis point cut. Having the probability market still show above 50 is certainly encouraging, even after yesterday's terrible comments. That was just unnecessary. They're in no way, shape, or form part of the Fed's mandate in any way that anybody can possibly articulate. So it's a terrible meeting. It affected markets, which is why we paid attention to it. Markets are buying the dip today, it appears, and the Dow is certainly positive. Um, we'll see what happens with the Nasdaq being down about 1%. I'd say that that dip likely getting bought, but a lot of that downside came from earnings announcements yesterday. And I'm going to go through these. So we got Google, Microsoft, and Meta. Let's start with Google. Google absolutely, well, all three of them did a phenomenal job here. The company reported, this is Google, results that beat Wall Street expectations with revenue surpassing 100 billion for the quarter for the first time. $100 billion per quarter profit, or I'm sorry, revenue. $100 billion in revenue per quarter for the first time for Google. Here was the number. Revenue came in at 102.3 billion for the quarter. That's a 16% increase year over year. That exceeds analyst expectations of just about $100 billion for the quarter. They beat it by over 2 billion. Earnings per share came in at $3.10. This was significantly beating analyst consensus expectations of $2.33, beat it by almost a full dollar. The cloud growth, which is the main reason why the stock has really taken off after these just stellar earnings. Cloud growth, Google Cloud revenues jumped 34% to 15.2 billion for the quarter, beating estimates and showcasing strong growth driven by AI infrastructure and solutions. I'm coming back to that. So keep that in the back of your mind, this AI investment that all these companies are making and will continue to make, which is certainly affecting some of their share prices. So stay tuned. Increased AI investment. Alphabet raised its spending guidance for AI data centers in 2025 to over 90 billion for the year, signaling a continued focus on artificial intelligence infrastructure. Stock is certainly up. Last I looked, it was up about 5%. Still looking for the most recent trade as I'm delivering this podcast for everybody today. But as we move on, Meta Platforms reported its third quarter earnings yesterday, and the company beat revenue estimates but missed on earnings per share due to a one-time non-cash tax charge related to a new tax act, the big beautiful bill that was passed in July. I'm going to come back to that topic in a second. But for Meta, their revenue came in at 51.24 billion, a 26% increase year over year, which beat Wall Street estimates. Earnings per share came in at $1.05, significantly lower than analyst estimates of $6.70. However, had it not been for that nearly $16 billion non-cash income tax charge, Meta would have beat analyst expectations for earnings per share. Actually, the adjusted earnings per share was $7.25 after excluding that one-time tax charge, which would have blown away Wall Street's expectations. Now, getting to that tax charge from Meta, which is what's causing the negative volatility on Meta shares here today. That $16 billion tax charge is a one-time tax charge. The company expects that this will lead to a reduction in federal cash tax payments in the future. The company, Meta, announced a continued increase in capital expenditures due to AI infrastructure. And this is what's concerning Wall Street today. Spending on AI talent is also expected to drive expenses in growth for 2026. Excuse me. Um, User growth at Meta, daily users across Meta's platform grew 8% year over year, which is worth noting. And Meta issued a revenue forecast of 56 billion to 59 billion for the current quarter. Lastly, Microsoft, covering this real quick. Microsoft released their earnings. They beat top and bottom line. Revenue growth 77.7 billion, surpassing the 75 billion markets expected. This is an 18% increase year over year. Every one of these companies double-digit increase in their top line revenue. Earnings per share for Microsoft for the quarter, $4.13. This beat analyst expectations of $3.67. Net income, 27.7 billion for the quarter for Microsoft. This is a 12% increase, again, double digits. Cloud revenue, which is what everybody cares about. This is Azure for Meta, or sorry, for Microsoft. That's 30.9 billion. This is a 28% increase year over year. I'm sure that was the intelligent cloud revenue. Azure specifically, revenue grew by 40% year over year, exceeding consensus estimates of 38%. Now, everybody today, not everybody, because all the Google shareholders are very happy seeing, you know, around 4 to 5% positive share price appreciation given their excellent earnings. But Microsoft, kind of a down day for them, but certainly for Meta, taking this tax charge again would have absolutely destroyed their earnings per share had that not happened. So the question begs, why take a tax charge? What does that even mean? There's a lot of people out there that probably don't fully understand that. And I think that that's definitely evident given the share prices, at least at one point in time today, last I looked before the podcast, shares of Meta are down 10%. I saw it down as much as 12% before the market opened today after delivering the top line revenue numbers that I just described. So again, for Meta, their revenue, 51 and a quarter billion, 26% year over year growth, which is phenomenal. So why did they take this charge and what is it? This is an accounting action. Um, and I want to get to the benefits of this as well. The charge is a one time accounting maneuver that was triggered by a new tax law from the Big Beautiful Bill, which forced Meta to recognize a quote valuation allowance against its U.S. federal deferred tax assets. It was a non cash tax charge, meaning it was an accounting entry rather than an actual cash payment made by the company during the quarter. For Meta, the long term benefit is a reduced U.S. federal cash tax burden for the rest of 2025 and for the future. For a company like Meta, writing off a quote charge off assets typically occur in current internal accounting records and can result in significant benefits down the line, such as reduced future taxes. By recognizing a charge this quarter, Meta was able to accelerate tax deduction. This will allow the company to pay less in federal taxes for the remainder of 2025 and beyond. So this is actually a good thing because it's legal. It's based on IRS law and accounting principles. Companies do this occasionally throughout the years. They're certainly not the first or not going to be the last. I'm sure that they're going to do this again. The bottom line is this: they took a one-time tax charge, but really the question becomes: is all of the angst today, as I watch all the major news outlets in the financial world, so CNBC, Fox Business, all of them, okay, watching Barron's, the whole thing. The question really becomes, well, if they're going to spend hundreds of billions of dollars between just these three companies, and by the way, tonight we get Amazon and Apple, two other big ones. They're going to spend a ton more money on artificial intelligence. So we got Google, Microsoft, and Meta spending roughly, if you add it all up, about $200 billion between the three of them almost quarterly on AI infrastructure. Now, Google blew off the doors of all their revenue and earnings expectations. So, for all three of these companies, how much of their revenue was generated from these AI investments? That's what we really want to know. And unfortunately, the news is not talking about any of this stuff today because, again, why would they talk about something good? It's not going to placate to your emotions. Okay. This is why you should like, share, and subscribe to Shepherd Wealth Management Podcast. Give this stuff as a great Christmas gift to your friends, family members, and coworkers because you will make more clear, consistently better decisions with this type of historical data. Now, Google, Alphabet, Google Cloud. The cloud division saw a 34% year over year revenue increase to 15.2 billion. This was driven by artificial intelligence. Strong demand for AI infrastructure and cloud services from developers like OpenAI, which is about to go public next year, probably going to be a $1 trillion company in its initial public offering. And Anthropic fueled this growth. I could go on. There are others as well. The company reported a record order backlog of $155 billion with over 70% of cloud customers using its AI products. Seems like that investment in AI is paying off. I could go on. I will. Advertising, AI powered enhancements help drive a 15% increase in search and YouTube ad revenue. Gemini AI model is credited with improving ad targeting and boosting engagement. Damn, that sounds an awful lot like Meta. That's what they do. Targeted ads. They use it. I'm about to get to them too. This actually for Google, Alphabet, is requiring them to increase their spending. They're getting their return on investment. Nobody is talking about this in the news today. Okay. This is why they're going to spend what they're spending. Let's get to Meta. Advertising. Revenues from Meta was up 26% year over year to 51.2 billion in Q3 of 2025. AI improved ad performance, contributing to a 10% increase in the average ad price. I wonder why in the hell they got to increase their ad prices, because they can show marketers, businesses they're trying to market in front of their current customers as well as prospective customers. You would like to know, hey, Ez, you run an advertising agency. I want to target this demographic of people. What's the probability with your ability to market to them that we can convert them from prospect to customer? They can actually show that data. That's what all this AI stuff is all about, specifically for Meta. And they forgot to mention, it slipped my mind. Sorry. Half of the world's population, 3 billion plus people using Meta's platform every month. It would be pretty helpful for the future of their growth if they got really damn good at making ads targeted to those people on the platform every month. Don't you think that might be a good thing specifically for the shareholder? So here we go. Here's the numbers: 26% increase year over year. I just said a 10% increase in the average price paid per ad. AI powered ad tools have reached an annualized revenue run rate of $60 billion. What about the user engagement? That's got to be important. AI powered features have helped drive an 8% annual increase in the daily active users across its apps. This expands ad inventory and boosting ad sales. And of course, they're going to increase their spend to do that. I'm going to make a point on that spend here. If you haven't heard it already, it's actually paying off. Microsoft, Azure cloud revenue saw its revenue increase 28% to 30.9 billion, with Azure and other cloud services growing at 40% year over year. Microsoft's AI partnership with OpenAI, again, and strong customer demand for AI services have been key factor. Copilot, I use it every day. I use Copilot every day. And more people, specifically businesses, are using Copilot, the AI assistant integrated into Microsoft 365, is driving revenue growth in the productivity and business process segment. And lastly, increased spending and net income impact. Microsoft's capital expenditures rose sharply in 2025 to keep up with AI infrastructure demand, just like the other two that we've just talked about, Meta and Google. The company, this is Microsoft's net income in Q1 of 2026. So this is, their fiscal calendar year here difference. Also took a $3.1 billion hit due to an investment in OpenAI. In other words, they took some of the money that they made from AI, helping them drive more cloud growth. It invested 3.1 billion in OpenAI, or their numbers would have been even better. So lastly, if you're a CEO of any publicly traded company in the S&P 500, you really have three choices to make with your cash flow. You can pay no dividend at all and reinvest those profits right back into the business. This is Berkshire Hathaway 101. From the day that Berkshire Hathaway was taken over by Warren Buffett and Charlie Munger, they've never paid a dividend in the history of Warren Buffett's tenure at Berkshire Hathaway, and he's 93 years old. He's been there since 1965. Never paid a dividend. What did that translate to, Ez? That translated to an average result for shareholders of 20% over all those decades. The market's averaged 10. Never paid a dividend. Okay. What's the other option? You could pay a dividend. Some of these tech companies do. Apple finally did. Or the other option is the third option. You could buy back your own shares. That's kind of like a dividend for the shareholders, right? So those are your three choices with the cash flow that you have of a publicly traded company. Now, why would you invest it back into your own business? Because you think the return on that investment is going to be far greater than it would be if you otherwise just would have paid out a cash dividend to shareholders. That's in fact in the best interest of shareholders. You can actually look at their earnings numbers and point to very specifically what was the impact of all this AI investment. You can clearly see it. Unfortunately, like I said, the news is not going to be sharing any of this information with you because, well, why would they? It's just too damn positive. I want to hear it. I'm sure a lot of other people would love to hear it. I bet you if they weren't, if they would actually share this information, that their share prices, specifically for Meta, would not be acting the way that they are. Because what'd you see in the headline news? Meta missed their earnings expectations. That's what you saw. And if you didn't actually take the time to do any research, or you could just use Copilot, by the way, or Gemini, or Google for that matter, because they got the AI mode already built into there for you for free. And say, hey, how much of Google, Meta, and Microsoft earnings were driven by revenue from artificial intelligence? You would have more information than anybody that's talking on any of these major news outlets right now. I don't know. I mean, this is I should thank all of them because they've given us here at Shepherd Wealth Management, myself, my team, a huge opportunity to take advantage of, and we're glad to do it every day because we will bring this information to our customers to help them understand. Well, what is the real risk of owning these companies here today, given their size, their growth that they've already had this year, the big spend, which is a major concern. It seems like for the news here today, that's causing a lot of this investor reaction. If you actually take a second to do research, and hell, the research is done for you these days with AI. I mean, if you can't see the value in that just by typing in that simple question, you get all the information I just described. And it's all highlighted for you in black bold letters. Um, it takes you about 30 seconds, minute, maybe to read all this. It's unbelievable to me. So, the other question that comes up, and we do this every quarter with customers. So, quarterly reviews. Big part of our value proposition here at Shepherd Wealth Management is performance and service. On the service side, of course, you can't guarantee performance. You can have some degree of control by controlling asset allocation, all these other things that we talk about regularly in the program here to give you at least some indication of where you might fall performance wise, given all the historical precedent of modern portfolio theory and a whole bunch of other things that we could talk about. But on the service side, that is something you can control. Every business can control that. Matter of fact, every one of these earnings calls throughout every earnings season, that's usually what every CEO and CFO says. At the end of the day, we're here for our shareholders and our employees. That's all we think about. That's how we operate as a business is maximizing value for our shareholders, providing a great place to work for our employees. That's all you hear about. But what you also will want to take into consideration is a lot of those big name companies that do say that every single quarter, and they're all in the S&P 500, and some of them aren't. Some of them are smaller than that, but we're just talking about the S&P 500 here. A lot of those companies will say that, and then you go to use their product and service, and their service sucks. Okay, pick an airline. Probably have had bad service experiences there. Pick a cell phone company. I bet you've had some bad service experiences there. Pick a hotel chain. I just spent some time in the Omni. That was a terrible experience. They gave me all my money back and a free night. So we'll have to maybe give them a crack at it. I could go on and on. Federal student loans. You got to call those cats. You're going to have a bad experience that day. We could list them all out. But at Shepherd Wealth Management, we truly do believe in service. This is the reason why we do all this content creation that we do. Why we do all this stuff? Podcasts every 2 weeks, a weekly Friday blog, a monthly newsletter written at the beginning of every month, and then quarterly reviews. Sit down with every customer every quarter, either in person, on the phone, or on Zoom, going over, hey, this is the result performance-wise versus the S&P. Here's why you got that. Here's what your expectations should be throughout the remainder of the quarter and year. Here's why those expectations um, are what we think you should have. And it's all going to be based on data and historical precedents. Excuse me. And then how we plan on delivering on those expectations, changes that we made with our asset allocation. And we do all this stuff, one, because it holds us accountable to providing performance and service that customers expect. It also allows the customer to ask direct questions. It also provides them our perspective weekly about what's going on, headline news, why the news is saying that. What does history have to say? What do we think about it? And here's what our expectations are, given all that information. Why do we do all that? Because these big name companies that say they care so much about their shareholders and their customers that actually drop the ball pretty much every time or most of the time that you use their product and service, that gives us a competitive advantage here for our customers. I know for sure. Pick a bank, pick a big name company that we all know the name of that I used to work for, right? They're great companies to work for. In some instances, they do some good things for their employees and their shareholders, the people that they're trying to serve. But nobody, not one of those entities, is doing anything along the lines of service that we do. So thank you for giving us that competitive advantage. Um, Part of these discussions that we have with customers is not only things like the Fed comments that were made and how that affects the market. We can look back at history. Again, when the Fed starts a cutting cycle, the market expects more cuts. That's why even after the Fed chairman, Jerome Powell, said what he said for no damn good reason, there's still almost a 70% probability of another 25 basis point cut going into their December meeting. It's all based on history. So we get questions, of course. And these questions that we get from customers are almost always coming from either some article they read from some major news outlet or just the general news themselves. Or, of course, the smartphones, as I mentioned earlier, they get the little news notifications, right? And they just see the headline. That's all they got time for is the headline. And by the way, I mentioned this in another podcast. If the Federal Reserve chairperson is going to say those kind of negative things, and then again, last week we talked about this, said like the bank earnings. You give the microphone to Jamie Dimon. He always says the same damn thing every earnings season. It's always negative. Right? He's a banker. Understand who you're getting the information from. But you as a consumer, again, you got probably kids, animals you got to take care of. You got Halloween to prepare for. Then you got Thanksgiving. You're making plans for that. And you got, how am I going to budget for Christmas? Right? Day job. Usually, in most households in America today, both people are working. All you got time for is the little blip you get notification wise. And what's the message? Fed said all these terrible things, even though they did cut interest rates. You got Jamie Dimon, the biggest banker in the world, saying that the recession's always coming. Right? All this stuff. What are you going to do? What are you going to do with that information? You're probably not going to do anything at all and just act like everything's okay and kind of bury your head in the sand like an ostrich. Hope everything works out. Hope's not a great investment strategy. So that doesn't work. Or the other option is you do actually take action. You sell all your stuff in a bull market. This is up 14% year to date, and you end up in cash. And now you don't know what to do if the market starts to go up. You're going to be like, oh, I'm missing out. Well, am I buying at the right time? Are we already getting close to a top? And that's where the question comes in. Are we in a technology bubble? Right? The AI bubble question comes up a lot. And here's my response to that. This is what I would encourage you to do as you go about your holiday season here, because I'm sure that some way, shape, or form, the stock market conversation is going to come up. And a lot of people are going to jump on this bandwagon of, we're in a bubble, AI bubble for sure. Well, I just gave you the reasons why you're probably not in an AI bubble, given that you can actually point to specific revenues and profits given all those investment dollars. But how about this? This is way easier for everybody watching and listening to this. This is what I want you to do. If your aunt, your uncle, brother, sister, mom or dad, whoever starts talking about, stock market and this bubble and all this stuff with AI, you can pull out all the earning stuff that I just talked about. Hell, it'd be a great value for them if you just, showed them the Shepherd Wealth Management podcast. But this is going to make you look like a financial I want to say genius because that's too much of a strong word, but like you're really in tuned to what's going on. It's probably going to open some people's eyes, especially if this isn't, maybe your area of cup of tea. This conversation comes up. Here's what I want you to do: ask him this question, and you gotta frame it right. So everybody's probably at least heard of Nvidia before at this point. I think it's that. I don't know, Ez. What's your take on that? I would assume, even if you're not like watching the market every day. You're probably just a casual person that maybe looks at the news, market stuff a couple times a month, right? On top of your regular, news watching process. that people go through, probably a couple times a week, maybe at least a couple times a month. They're hearing something like that. I would imagine. I'd love to hear your take on this because this isn't what you do every day. As I would imagine people have at least heard of NVIDIA at this point, given all the chip issues that we had with COVID, right? It kind of made everybody aware of the importance of all that sort of stuff. That's just my take on it. I don't know if you have a thought on that or not.
Oh, 100%. I mean, just because of the relevance of NVIDIA outside of it being one of the big seven, right? I mean,
Yeah.
also, it's probably the most reported on big seven stock. I mean, you don't hear about Google doing good or, Alphabet or Meta, but constantly see a headline for, oh, NVIDIA's, up so much.
Yeah.
And, with the CHIP Act, the infrastructure bill from the previous presidency, chips being the center stage. Yeah, I'd say everybody's heard of NVIDIA, even if you don't really know what it is. You've heard of
Yeah,
the
I did a
story.
quarterly review with a customer yesterday. He's been around just over 4 years now. We've held Nvidia throughout the entire time in bigger chunks than others, but no kidding. This guy's performance on just that stock, again, he's one of our first customers. It's over 1,500% return just in that name alone. Okay, so Nvidia is a $5 trillion chip maker. They are the largest chip maker, the only $1 trillion chip maker, but they're 5 times over trillion. Maybe AMD just hit a trillion, something like that. But $5 trillion is the market cap. If you took all the shares of Nvidia around the world based on its closing price yesterday, its market cap is $5 trillion. Now, their profit margins average about 75%. Okay. They make the chip that everybody wants. All these numbers from Google, Microsoft, and Meta from a spending standpoint, it's all going to NVIDIA. That's where the majority of that money is going. And you're going to hear from Amazon tonight, same thing. You're going to hear from Apple, same thing, on and on throughout all the earnings season for all these big tech names. And why? Because they're getting the return on investment. I can point to Palantir, right? They haven't done their earnings yet, but it's going to be good. They had a mic drop earnings last quarter, blew it out of the water. The stock is reflecting that. Okay. I could go across the list of other companies too, not just the big names that everybody else has heard of. But let's use this. You're at Thanksgiving, Christmas time, and somehow, some way, sure enough, this conversation comes up about stocks and this thing called AI bubble. Everybody likes to talk about a bubble after 2008 for some reason. I think it lets them feel a little smarter somehow, like they're gonna know when the bubble is gonna burst, just like they didn't know when that bubble was gonna burst in 2008. So it's kind of a poor talking point, but it's gonna come up for a lot of you. So here's us helping you be prepared for all that. Ask them this, because everybody remembers PE ratios. I don't care if you have no experience or you are, in it to win it. This is what you do for a living, like I do. Everybody understands PE ratio, price to earnings ratio. It's the only thing that these people want to talk about, by the way, on the news. Ask them this. This topic comes up: AI bubble. What are your thoughts? Bubble's going to burst, right? Did you get out of all your tech stuff? Ask them this. Well, before I give you my take on what I did with my own portfolio, let me ask you this, Uncle Bob. What do you think the forward PE ratio is on NVIDIA compared to Costco, as an example? And by the way, if you weren't familiar with the profit margins on NVIDIA, this $5 trillion tech name that I know you've at least heard of, it's 75% profit margins. And they're by far the largest chip maker in the world. Whereas Costco or Walmart, as an example, let's use Costco. Costco is a retailer. They sell some apparel, they sell you insurance, they sell you tires and food stuff, right? You can buy gold there. You can buy some technology there too. They sell a little bit more, let's say, than Walmart. What do you think the PE ratio, forward PE ratio is for this huge chip maker with 75% profit margins and a retailer with retail profit margins? Albeit Costco, going to be a little bit better profit margins than some others like a Walmart, let's say. So I'll give Costco a good example here. What do you think it is, Uncle Bob? Well, Uncle Bob, like most of you, will probably say some sort of astronomical PE ratio. Like, for example, Amazon, Tesla, they've always had, nosebleed profit or PE ratios, right? And for all of those that use that as an excuse to never own the shares, well, how'd that work out for you? Not very good. Well, here's what Uncle Bob doesn't know. is that NVIDIA's forward PE right now is 34. Is that high? Well, Costco's forward PE ratio is 47, damn near 50 for a retailer that does not have 75% profit margins. So, Uncle Bob, knowing this information that you clearly didn't know before you asked the question, would you say that we're in an AI bubble? Uncle Bob's going to look at you like, hey, man, what have you been doing on the side to understand all this information? And then you could probably point to a whole lot of other stuff, which I just described. You got all of the biggest tech names that everybody knows: Google, Microsoft, Meta, Amazon, Apple, Palantir. This is all that you're going to hear on their conference calls. This is the only thing you're going to hear. You're going to hear some blowout earnings, and the spending on this stuff isn't going to slow down at all. Matter of fact, it's accelerating across the board. Where's all that money going? Damn near all of it is going to NVIDIA. The only problem that they have is they can't make the damn stuff fast enough. That's a good problem to have. There isn't a CEO of any company, public or private, that does not want that problem. But yet NVIDIA's price to earnings ratio is substantially below a retailer like Costco. Where's your AI bubble? Especially when you can point to actual profits and revenues driven by AI. Doesn't make a lot of whole damn sense to me. And everybody getting all their panties in a bunch here about all this spending for AI is leading to profits. That's what you want. What is there to be concerned about here? And the reason why everybody's concerned is, again, the news is not giving you all of the detailed information about the earnings and why these CEOs are going to continue to spend money on it. And by the way, this brings us to what to do. Trump's first term in office, market's up over 80%, which is an amazing 4-year run on the S&P for any presidency. But the top 4 performing sectors, and we've said this all year long: tech, consumer discretionary, industrials, and financials, pretty much in that order. Those are our top 4 performing sectors in his first term. That's where we're overweight right now for our customers. Why is that, do you think? It's not just because of the profit margins. It's not just because of the history. What it's also about is just some basic common sense. Think about this. If all of these companies combined are going to spend hundreds of billions of dollars a year, and eventually it turns into trillions of dollars over time, right? Every one of these CEOs and their shareholders are looking for a return on that investment. That's what the news is getting everybody all excited about today. Well, where's the return on the investment? You didn't tell your audience. It's right here. All you needed was a computer connected to the internet. That's it. It's right there. They're not going to tell you about any of that stuff because it's not going to help them in any way, shape, or form. They're going to keep spending. Now, here's my point. If you're a CEO spending that kind of money, and we're shareholders, audience might be shareholders too, especially if you're a Shepherd Wealth Management client, you're definitely shareholders. We do, and they do expect a return on investment. We're seeing it. But the only way to recognize the full potential of the return on investment that they expect to have happen is you have to have the infrastructure in place to allow for that to have a chance to take place. So what does that mean? Let's put on some common sense here. What that means is if you're going to move the earth to build a data center, let's say, well, what's going to do that? Caterpillar's equipment. Caterpillar just did their earnings. They crushed it. They're up 12% post earnings. We bought it last quarter with profits from tech. Okay. I want to be a shareholder there for a little while. Industrials have a long way to go to get back up to the type of PMI information that we're looking for. We've talked about that on all kinds of podcasts before. So definitely like, share, subscribe us. All right. Once you've moved the earth, thank you, Caterpillar. Your earnings are going to kick ass for that. Once you've done that, well, banks are going to have to finance some of this. Interest rates are going down. Loan demand is going to go up. That's great. Banks are going to be profitable with that as well. All the bank earnings, probably the best earnings that group has ever had in quite some time. Specifically, Goldman Sachs, which we bought going into their earnings, expecting some of the M&A that has picked up to continue, profits from trading, so on and so forth. Goldman Sachs is not just a bank, but it's also a way you can go about investing. Killed it, along with all the other big banks. Thank you. Glad to be a shareholder there for a little while. And then, before you can do all the tech stuff, that all these tech companies are investing in. They just built the data center. Caterpillar's equipment did that. They financed some of those operations through some banks. Thank you for that. Now you got to power it, specifically with electrical power, whether that's coming from small nuclear reactors or some other way. You have to have the power for this infrastructure. Take a guess of the types of companies that are probably going to win in that environment. Emerson Electric, big one. Quanta Services, huge industrial power player in that space. I could go on. There are some others. And by the way, for all the compliance people out there, I have no recommendations for anybody that's listening to this program, specifically those that are not clients. Only recommendations are for our clients who we really understand their situation well. Um, and we don't get any kickbacks from any of these companies in any way, shape, or form, or any other financial product that we might talk about on this show. Of course, investing involves risk, and past performance is no guarantee of any sort of future success. So now that we got that out of the way, these companies are doing what they should be doing, which is generating a profit right here, right now, and looking forward on behalf of their shareholders and saying, what is the best way to allocate my capital to do that? They're doing it, and the numbers support them to do that. Until otherwise proven wrong, they should continue to do what they're doing. If they don't, somebody else will. And if that somebody else is a direct competitor and they happen to be first, well, now you don't have much of a mode of safety anymore, in the words of Warren Buffett, meaning that others are now starting to eat your lunch. None of these companies got to where they got by letting others eat their lunch. Have they always made perfect investments for the future? Of course not, which is why human beings are always going to point back to the uncertainty of all this investment. Well, is it really going to drive engagement and all this cross selling and so on and so forth? The answer is yes, it's doing it in spades. And we just got started with all this stuff. It's not like we've been doing all this AI investment for a decade. This stuff just started to happen. And you can actually point to actual real life results for that. So I hope you got a lot out of today's particular program. We covered a lot of ground here today. We got right to the meat and potatoes of yesterday's news, which caused a whole bunch of volatility. We're still dealing with it here today. Powell's comments completely unnecessary, not even justified, and I'd be willing uh, to make a projection here that we do in fact see a third 25 basis point cut in the next Fed meeting in December. We'll see. We talked about our take on all those comments, why we still see them as beneficial to risk assets like stocks. In other words, Fed being dovish, regardless of what he had to say yesterday. Probabilities are supportive of that. We talked about some of the biggest questions that we get from customers during our quarterly reviews, this AI bubble. Gave you guys some really good tools to use as those types of conversations happen this holiday season. And of course, the big tech earnings. Covered that in great detail, better detail, in my opinion, than any of the major news outlets. And then tonight, after the close, 4 o'clock, Amazon, Apple, Strategy, formerly known as MicroStrategy, the largest crypto holder in the world, will be announcing their earnings as well. So be paying attention to all of that. And we'll certainly have a lot of comments to say probably in the next podcast in a couple weeks. But certainly be writing about this for our customers tomorrow as well. So please like and share, subscribe to Shepherd Wealth Management Podcast. Check us out, shepherdwm.com. Get a whole lot of background information about myself, the firm, all of our team members. And like I said, in about 2 weeks from now, we'll be doing this again. So look forward to seeing you guys on YouTube and Spotify at that time. Hope you have a great rest of your Thursday, a great week. Good end to October. Happy Halloween. Stay safe out there. God bless you guys, and we'll do this again in a couple weeks. Take care.